Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. I want to thank everybody for joining us. My name is Robert Kuhn. You're listening to Destination Retirement. As you know, our job as a fiduciary headquartered outside of Chicago in Naperville is to make sure that we're incorporating strategies that can and show characteristics to be able to deliver positive returns in negative markets. And if you've listened to the show any length of time, you understand that we also believe that tax reduction strategies are the most overlooked area of financial planning. We have started to offer our portfolio stress test report free of charge. So if you have an interest in learning how your current portfolio it would do well in various markets, whether good or bad, we want to make sure that you have that available to you. Actually, a lot of individuals called last week. I love it. That means people are being proactive. So if you'd like to have a conversation with myself and my team about your individual situation, please just give us a call, 630-492-1912, 630-492-1912. And Jenny or Paige will set time up for us to have our initial conversation. Lots going on, obviously, in the market. Doesn't seem like the market ever wants to go down. I love it. But we do want to make sure that your plan, your income needs, your future goals and objectives with the resources that you currently have don't require a rip-roaring market to make sure that you achieve them. And when we see headlines like corporate insiders are dumping stocks at the fastest pace in more than 2 decades, it should give you pause. Pause doesn't mean we think the market's going to crash. It doesn't mean that we think the market is going to sell off in a meaningful way, that we're going to have another 2000 or another 2008 or another 2018. But it certainly should give you pause. And it's one of the reasons that, as you know, we do a lot of banknotes. Banknotes are offered by the largest banks. They're called structured notes. There actually is a much longer legal name. That's just kind of the generic name. We tend to focus on notes that pay coupons on a monthly basis, and we generally try to get over 12% with 30% downside protection. So what that means to you is that you can still deliver double-digit returns as long as the indexes that note is tracking are not down 30% or more. We recently did, last week, a Morgan Stanley note, and I believe it priced at 12.30. And it was tied to the S&P, the Russell 2000, and the KRE, the Regional Bank Index. And again, that is bringing a level of predictability in a very uncertain market. And we love those strategies. Doesn't mean that there's not risks. Doesn't mean that you don't. We need to obviously discuss those. Past performance is not indicative of future results, of course. But when you can bring strategies like that to the table, and you are one of the very few on a percentage basis that has adapted that strategy, even though it is a couple $100 billion a year market, that's a significant competitive advantage that we bring to the table. But I want to share a story with you. And I generally do not kind of bring stories like this to the radio show, but I think it's important. In this industry, we believe in integrity. We believe in a level of professionalism when you are talking about other advisors, other clients' portfolios. And sometimes, unfortunately, that is not reciprocated. And as you would imagine in this business, you have all types. And we ran into a situation last week that I can tell you, not often can I say that this was a first, but it was a first. And I was very, very disappointed with the lack of professionalism from this firm and this investor. And it surprised us, and it is just unfortunate because in this business, in a lot of, I guess, when you're looking at situations where, your revenue is generated from the amount of money that you manage, there's a lot of advisors out there that are hurting. There's a lot of advisors out there that portray an image. There are a lot of advisors out there that have lost a lot of clients due to just lack of proper portfolio management. And when they get in front of a client that has decent amount of money, they will say, or investor rather, they will say and do things just to get that client, even if it is unethical. And that was a situation that we found ourselves in this week, and it was very, very interesting. So one of the banknotes that we do, we do obviously the biggest and the largest banks in the world, honestly. And this bank happened to be BNP. Now, BNP may not be very well known to people here in the United States, but in the finance and the global world, their credit rating is A+. One of the strongest credit-rated banks in the world. And if you look at their credit default swaps, and that's basically just the the cost to insure defaults on bonds, it's one of the lowest. And so this investor had, we had talked about, this bank, and we've talked about this note, and he went to meet with another advisor. I would love to say the name, but, after 25 years in the business, I've recognized that paying attorneys because you use names is probably not best suited for my finances. And so I'll refrain from using names, of course. But anyways, so this individual is meeting with this group, and they proceed to tell this individual that BNP has been in bankruptcy since 2019. Think about that. 2019, the lack of knowledge, the lack of the ability to do a quick Google search to see that. That's almost like saying, well, this high school team can go and beat the Chicago Bulls. That is how outlandish of a statement it is. And unfortunately, I put a lot of the responsibility on the client to just do, or the investor, to just do some basic checking. My goodness. And, but that's what you deal with a lot of times. Just, A+ credit rating, higher credit rating than JP Morgan. And you find in this industry that if that is the way that somebody wants to try to start a relationship with a new investor by telling them outlandish falsehoods that can be easily checked in 1 second, is just beyond me. And then for the investor to believe it is, my goodness, with a quick Google search, I don't get it. And unfortunately, in this industry, you see a lot of that. And for those of you that have talked with us, that the level of professionalism, even if we're not managing the money, that is something that we will never change, because we don't need your business. That's the reality of the situation. And do we want to help you? Do we want to grow the business? It goes without saying. I wouldn't be doing the radio show if I didn't. So, don't take that as thinking of ourselves as so high and mighty. But the reality is we don't need your business. We have a very good business. We have a very good client base. But we do want to help, and we do want to educate, but we will never, ever, ever lower our professional standards in telling people something that A, is not true, B, can be factually checked in a second. But at some point, clients, investors, potential clients, the buck stops with them, man. And, if that's how people want to establish relationships, it is very, very sad. And it's one of the reasons, and when we meet with individuals, and if you do want to have a conversation, 630-492-1912, 630-492-1912, Paige or Jenny will set that time up for us. But if you want to work with a group a financial advisory firm, a fiduciary that does different things. As you know, I talk a lot about it on the radio. The bulk of how your money is being managed, I'd say 9 out of 10 individuals is you simply have a closet index fund strategy. What does that mean? That means that your advisor tells you it's spruced up, it's custom, it's this, it's that. But at the end of the day, it just simply tracks the market up and down. And then you pay a fee for that right. And I never understood that. So one of our greatest strengths as a firm, one of our greatest competitive advantages, if you look at what our 30-second elevator pitch, the elevator pitch is really simple. Listen, we're going to bring strategies to the market, strategies to the table to incorporate in your portfolio that have the characteristics to deliver positive returns in negative markets. And one of those strategies is the bank notes. If you don't want an A-plus credit rated bank that you're going to make over 12% with 30% downside before you don't get paid that coupon, well, then you know what? We don't want you as a client, because if you don't see value in that, then you're just not a good fit for us. But those are the things that we're bringing to the table. Now, again, one of our greatest strengths is distinctly different buckets, distinctly different strategies. We can look at a client and say, you know what? The correlation of your portfolio is not the market. What does that mean? The correlation is a simple metrics of how your portfolio moves versus the broader indexes. Well, guess what? Most clients that we have taken over from other advisors, the correlation is darn near 1. What does that mean? You're going up with the market and down with the market. And you have to ask yourself why. Why? Why would you do that? Yes, it might be spruced up to be so sophisticated. It's so customized. We're the only one that does this, the only one that does that. I've lost my ability to, you know what, a long time ago. We're just going to tell you how it is. And so, yeah. But again, the flip side to bringing distinctly different high institutional strategies that I think are so basic, I mean, absolutely the most basic, but yet generally the retail advisor hasn't embraced. You know, you look at our tax strategy. I mean, think about this. We have a tax strategy. So if you sold a business, if you sold a building, if you sold, if you're a high wage earner, physician, doctor, attorney, whatever, garbage man, it doesn't matter. If you make a bunch of money and you have had a liquidity event in your business and you want to mitigate taxes, we have an energy strategy that last year reduced your taxable income by almost $90,000 per $100,000 invested. And at $65 oil, the targeted distributions are 20%. Could be more, could be less. We're not tax advisors. So anything that we say when it comes to taxes, it's for informational purposes only. Best practice is always reach out with your tax professional provider before you make any decisions based upon taxes. Now, that being said, they're just black and white in the tax code, but it is what, we have to give those disclaimers. But think about that. Here's a strategy that last year reduced your taxable income by almost $90,000. What will it do for 2024? I don't know. Could be 50%, could be 60%, could be 70%, could be 90%. But it is significant in the first year. Generally, you're going to get to 100%, whether it's all in year 1 and then some in year 2. And then you have targeted distributions that are not correlated to the S&P. So those are the strategies that we're bringing to the table. Now, the downside to that is when we talk with clients about the bank notes, the principal protection strategies, the energy strategies, inevitably we hear more times than not, why doesn't everybody do this? Well, that's a really good question. But here's the downside to having that unique, that sophisticated, that high level of an offering is it's going to be new to you. And so it's going to take several meetings for you to fully understand how they incorporate and how they are incorporated in an overall plan. So bubble warning in the U.S. corporate bonds. We'll talk about that after the break. So give me a call if you have an interest. Give us a call. If you'd like to talk with our team, first way to do that is to reach out to Paige. If you want that stress test done for you, it is complimentary. It's phenomenal. 630-492-1912. 630-492-1912.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement. I am Robert Kuhn. That is my name. I am the founder of Kuhn Capital Partners, co-founder, actually. My son and I actually founded the firm. I love it. I am responsible for day-to-day operations. Everything runs and stops with me. So that being said, our job is to make sure that we are bringing you, the investor, the most cutting-edge risk management strategies that the bulk of advisors simply are not incorporating. Sounds like a big old sales pitch, doesn't it? But the reality is it's true. And so if you want to learn more about what we're doing and the value that we can bring, whether it's tax reduction, whether it is income maximization, make sure that you reach out and schedule a time to talk with with me, but Paige or Jenny can set that up. You can do that by calling 630-492-1912, 630-492-1912. So you look at the markets again. We talked about in the first segment, corporate insiders are dumping stock at the fastest pace in more than 2 decades. That's interesting. Very, very interesting. And it certainly doesn't mean that the market is going to fall off a cliff, but you have to stop and you have to wonder why. You have to wonder why. Again, when we're in meetings, we often get asked, hey, how often do you monitor the portfolio? Well, given that it's actively managed, given that we're bringing strategies to the table that are actively managed in their own discipline, we monitor those strategies on a daily basis. And then another client asked, they are to be a client, so they're actually coming on board. They hired us, and we're in the process of moving money over. And we'll talk about what that looks like here in a minute as well, because we're often asked about that. But how often do you make portfolio allocation changes? Again, in this business, unfortunately, most of the time, since there is no risk management and since Wall Street wants you and management of the big banks, the big brokerage firms, they don't want their advisors sitting there staring at a screen. They want them out bringing in more money. Why is that? Well, they get paid more. Revenue goes up. So they want you to understand that you can't have a portfolio that all it does is track the market up and down. We call those closet index funds. And if you run the portfolio stress test, again, we are giving this away complimentary. You may think it's not, well, I don't know what you think, but it may sound like a simple report. There is nothing simple about this report. When you can take your current portfolio, benchmark it to 100 different adverse and positive events historically, and then look at how your portfolio would perform. And you know what the beautiful thing about that report is? It takes away every single sales pitch known to man. It's not about what I think. It's not about what your current advisor thinks. If you're managing the money on your own, it's not about what you think, because candidly, it just doesn't matter what I think or you think or your current advisor thinks. So many advisors in this business, they just sit and justify why they were wrong. And I just never understood, having a portfolio that just tracked the market up, tracked the market down, and then paying a fee, having a client pay the fee to do nothing more than track the market up and down. If you want your money managed that way, you don't need to work with an advisor at a big bank, a big brokerage firm, or our firm for that matter. Go to Fidelity, sit with their consultants. I wouldn't do that. That's not how I would manage my money, but who am I to tell you how to manage your money? If you want to track the market up and down, and you believe that over 3 to 5 to 7 to 10 years that the market's going to be higher, and we're going to talk about a statistic here in a minute to make you think, but if that is how you want your money managed, don't pay that 1% fee, that 0.5% fee, that 2% fee. That's just a drag on your portfolio. And you can go to Fidelity. We have a custodial relationship with Charles Schwab. What does that mean? That means all of our clients have accounts at Charles Schwab. We're the advisors. But they have retail advisors that, you don't work through a private, a fiduciary like ourselves. Don't pay the money if you just want to track the market up and down. Go to Vanguard. Do it on your own. I mean, sit with somebody once a quarter, once a year, twice a year, and have them reassure you when the market's down how it's ultimately going to be okay. Because that's what you're getting. 9 out of 10 clients out there, in my opinion, that is exactly what you have. But you don't know that until the markets go down. So take advantage of that stress test. 630-492-1912. We'll do it. We'll run it. Turnaround time, let's just say 72 hours. Here's the biggest thing. You have to get us your statements. Upload them to our secure portal. Email them through our secure email service. I don't care. We need to know your holdings. Spreadsheet your portfolio if you want to. People say, well, I can't send you my statements. They have an account number. We can't do anything with the accounts anyways. So that's the challenge, and it shouldn't be a challenge. It should take you 2 seconds to download your statements and send them over. But if we don't have your statements, we can't run the report. And so get us the report. And then it's going to tell you. Then it's going to tell you the value that your advisor is bringing to the table. And isn't it nice to know before something happens, even good or bad? I mean, think about your health, right? So many people don't want to get these body scans because they're afraid of the results. I get it. But what's the downside? I mean, what is the absolute downside? If something's wrong, you're going to get it fixed before it could have a life-changing effect on you. Now, portfolio and money, I don't think is anywhere close to our health, obviously, even though it's incredibly important. But the stress test, isn't it nice to know what exactly could happen historically with your current portfolio? And so what we have found is that when you have that report run, it does, again, you go back to your advisor and say, hey, what gives? There's nothing in our portfolio that you can point to, that I can point to, that you've explained to me that can generate positive returns in down markets to a point, or can preserve principal in down markets. Think about this. There's a 5-year strategy. Again, indexed annuity. Everyone says we're against annuities. Everybody says we're against annuities because we talk about how the income annuities we just don't see value in, even though they're sold at astonishing, rates. So you can't tell me that we're against annuities because we're not. And there's a 5-year index annuity. And what is an index annuity? It's tied to an index. That's it. There is no fee. It pays us a commission, unfortunately. I wish it didn't. I would much rather take, the fee, but you don't pay the commission. It comes from the insurance company. So your effective, rate is 0%. There's no active money management. This isn't an income annuity. And so, we talk a lot about annuities. I get a lot of emails and hate mail and texts that you don't like annuities, you don't like annuities. And it's like, no. We just don't like the bulk of annuities because there's not a lot of value, in our opinion, in those income annuities, at least how they're sold, right? So this 5-year annuity, index annuity, I look at it really as a structured note offered by an insurance company because the hedging is very, very similar. But it's tied to an index. Let's say the S&P. Currently, there's ones out there today that you can get 11% of the S&P on an annual basis. So 0 to 11%, you get 100% of that return. And that's pretty darn good. On the downside, each year, anything in the S&P, if it's negative, your return is 0. So if the S&P is down 1 or if it's down 50, your return is 0. And then if you get a gain, that gain's locked in an annual basis. So you don't have to play that catch-up game. Do you know how many people out there that would love to have that as a bond alternative? When you look at the 10-year, just fix, I'm not going to name names again, but pick your favorite 10-year bond fund. Just go, look at a total bond fund and look at the 10-year number, under 2%. Under 2% a year for 10 years. And you know how many people have lost money in the bond strategies recently? Oh, my goodness. I mean, with interest rates doing what they've done. So, yeah, here's a strategy that if you're content with getting 0, the first 100% of the return of the S&P price movement up to a cap, and the cap's currently 11%, some are 10, kind of all over the board. But that's darn good. Almost double, well, it is double digits. Some of them, double digits. And you have absolutely no risk to principal. Yeah, you know what? There's an index annuity that I would consider that's relatively short-term, 5 years, that could be very appealing for a lot of people for some money. And the reality is that we're not against annuities in any way, shape, or form. We're just against the bulk of annuities. So I look at this 5-year index annuity and I say, so what? I mean, call it what you want. I don't care what they call it. It's an index annuity, but there is no income component. Zero, none, nada. And it's a pure growth strategy. And so, yeah, if that's something that appeals to you for some of your money, you're willing to take 100% of the return up to a cap of the S&P price movement to, whatever that cap is, 10%, 11%. And when you get that gain is locked in. So you never give that gain back. And it's you have, 5-year money. So we see a lot of IRA money going into it. Yeah, that's a really good strategy. But here's what is so unique is that there's probably out of 100 different annuity strategies, there's really only 1 or 2 that we would use. So you're getting pure objectivity, okay? We're not going to tell you how and why a guaranteed lifetime income annuity is so great because, in my opinion, it's not. My opinion, it's just not because you don't know what you own. Everybody thinks they're getting 7% guaranteed. That's not how it works. And you have to think about this. The insurance companies know that account's not going to zero. They know the account's not going to zero actuarially, at least the bulk of them. So what benefit are you getting? And then for those lifetime income annuities, because again, the account goes to zero, then you're in the insurance company's pockets. But again, they give you just enough growth. They limit the withdrawals. And so they know the account actuarially is not going to zero. And you have to look at what is that going to do to inflation? What is inflation rather going to do to that income stream? So you can't tell me we're against annuities. If you want safe money, bond alternative, CD alternative. Now, these aren't FDIC insured, of course. They're backed by whoever the insurance company is. But if you want a strategy that is 100% principal protected, and it is relatively short term, 5 years, and each year they're going to look at the S&P or whatever your investment of choice is, and you get we like to use the ones that are tied to the S&P because that just is very easily understood. There are ones out there that are 5 years that are 10%, 11%, 9%, and you get the first 9, 10, 11%, and then nothing above that. And for that right, you get that gain locked in forever once you achieve it, and there's zero possibility of loss. That's a great strategy if you're conservative. So let's talk about it. So 630-492-1912, 630-492-1912. Certainly give us a call and we can talk about that. Bubble warning. I talked about that earlier. U.S. corporate bond spreads have fallen to an all-time low, which could be a sign of a issue. That didn't come from us. That was from S&P. And so when you look at the 10-year versus the 5-year, the spreads are alarming. That might sound like physics or foreign language to you. But again, those are the things that we have to look at. And it really just, so many people are still using fixed income as a means of portfolio diversification. I mean, my goodness, the bond market, look at what that's done over the last 5 years. I mean, it has hurt so many people. And you look at the 10-year strategy, your favorite, total market bond fund under 2% over 10 years annualized. Goodness. There's better ways out there. So give us a call, 630-492-1912, 630-492-1912. You will talk with Paige or Jenny, and they will set up our initial call, Zoom, meeting, whatever works for you. So after the break, we're going to talk about what does it look like when you wait for a correction and let your money sit in cash or on the sidelines. More after the break. Back. You are listening to Destination Retirement. My name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners. We're an independent registered investment advisory firm. That independent word is important. That fiduciary word is also important. We are fiduciary. We do focus on strategies that can deliver positive returns in negative markets to a point. We focus on tax reduction strategies. We focus on principal protection strategies for some of your money. Again, our job as a fiduciary, as an advisor, is to bring you a strategy that some of your money can perform no matter what's going on in the market. And in some instances, performance is just not losing money. I mean, how about that? What if the markets are down 20 to 30% and you had a strategy for that bucket of money that had zero possibility for loss? Would that appeal to you? Well, it should appeal to you. Again, do you put all of your money in a strategy like that? No. Should it make up a piece of your pie, a piece of your portfolio allocation, a bucket of your money? We strongly believe yes. So 630-492-1912, 630-492-1912. Give Paige or Jenny a call and set up your time to talk with us. A lot of individuals are reaching out for that stress test that we've now made complimentary. It's a very comprehensive report. Get us your statements. We'll run the report. We'll take a look at your portfolio. We'll benchmark it against up to 100 different positive and negative scenarios, and it'll give you something to think about. We also benchmark that against the index. So what does that mean? We'll take your current portfolio, we'll run it against the indexes, and then we'll let you see what value your advisor is bringing to the table. That is a report that I would strongly encourage you to do. We probably could charge $5,000 for that report. We are giving that away complimentary. So it's something that we're very proud of. We love the software. It's not ours, but we absorb the cost. That generally is going to be cost prohibitive for you. But if you want that done, again, just give Paige or Jenny a call. If you want to talk about your current situation, how to maximize your income, reduce your risk, add banknotes to a portfolio that you're able to get, historically double digits, as long as the indexes, the banknote tracks are not down 30%. Those are things that we're talking with clients. Tax planning is a year-long strategy. We're going to talk about that here in a minute. But again, give Paige a call or Jenny a call, 630-492-1912, 630-492-1912. So we have a lot of people that we've talked with in the past that have been waiting for a correction, waiting to put money to work. That unfortunately hasn't worked out. Again, when you're using gut feel, it generally doesn't work out. It may work out one time. Heck, out of 10 times, it may work out 9. But the 10th time, it doesn't work, and you get back all the gains from your gut being right, previously. The market doesn't care about what you think, what I think, what other advisors think. It just doesn't care. And another thing, the economy is not the market. You have to understand that. That is why the industry today, in my opinion, the most successful investment advisors, hedge funds, etc., are momentum-based strategies that don't care about what's going on in the world. They just follow the momentum. Mathematics, algorithms, doesn't matter, because the markets defy gravity. They defy logic a lot of times, and what you think should happen, the computers have already figured that out months ago. And you're just at such a competitive disadvantage. And so one of the things that we focus on consistently are repeatable strategies that are based and founded in math. And you look at the algorithms of some of the strategies that we utilize, they are so extensive and so complex that they're data scientists, PhDs that are writing these. And these are strategies that have been tested and around in some form or fashion. Now, they probably have been built on since the early 2000s. Our Growth Plus strategy that we utilize, again, we're just the conduit. We're the conduit to the managers that generally you can't get to. And our Growth Plus model, again, I'm going to qualify this. You don't make investment decisions based upon performance. Past performance is not indicative of future results. We have to understand that. Their performance in the Growth Plus bucket has destroyed the S&P 500 since 2015, since it was issued and open to individuals, okay? You're looking at a return of over 700% when the S&P is around 320. That is massive, massive outperformance. Massive outperformance. And again, should it be a lot of your portfolio? Well, it just depends on your situation. I don't know. But generally, it should be up to 10%. And I never understood why people don't have, clients don't have, investors don't have allocations to money that their mandate is to get after it, make money. And yes, you have volatility. That goes without saying. But it's based and founded in math. And that is, if you trust the math and you have 4 years where you don't need to sell if those markets are down, that you can ride out that volatility. That's why a lot of times, those should be a 5% allocation, 10% allocation, 15% allocation. Everybody's different. But again, it's having those types of strategies as part of an overall portfolio that when you can bring the strategies like the banknotes that can deliver, double-digit returns in many instances, as long as the markets aren't down, or the indexes rather aren't down 30%. Those are strategies that all of a sudden are really good strategies. Oh, you have a strategy that could reduce taxable income by last year 90%, almost 90%. So it was like 89.75. So you invest $100,000 in our energy fund and you reduced your taxable income, active or passive, by almost $90,000. Think about that, $90,000 with targeted distributions at $65 oil of 20% a year. Now, again, we're not tax professionals, so use that as just for informational purposes only. Now, the tax strategies are very black and white, but you get what I'm saying. That is the uniqueness of an advisory firm that is independent, that can bring to the table strategies that the big banks and big brokerage firms don't allow their clients, or their investment advisors rather, to offer. That, to me, is what a cutting-edge financial advisory firm should be. Yes, you have your, what I consider plain Jane, run-of-the-mill strategies, of course, but we have to circle that and surround those strategies with strategies that, like I mentioned, the banknotes, the energy fund, principal protection, the aggressive strategies. And that's how we're compounding money. We believe that we're the only group that I have seen, and I have a lot of friends in this industry, that are doing anything close to that. So if you're listening to us outside of the Chicago market, understand we can work together. We do run the show in multiple markets, 630-492-1912, 630-492-1912. And so we love the fact that our strategies and our philosophy is going to take more than one meeting. Because if you go to an advisor and you have a one meeting done and you sign up, goodness, you have nothing but the market. Again, closet index fund. Market moves up, you move up. Market moves down, you move down. Why in the world would you pay for that? Use that stress test report that we can run for you, now complimentary, to see just what value your advisor is bringing to the table. Because the problem with this industry, for advisors, there's no clearinghouse that everybody reports into that says your advisor is good. What makes an advisor good? I mean, in my opinion, it's all about performance. All about performance. Now, what we need to get better at communicating more, okay? We'll just be straight transparent. I'm laser focused on performance, and I'm laser focused on strategies. And if I was a client, I don't need the warm and fuzzies. Just do what you're good at, right? But a lot of people want the warm and fuzzies. And you know what? It's a conscious effort that we're making now into 2025 is to make sure that our client outreach, we thought it was good, we're going to become the best at it. And so we want to get better at that, and we will. But what makes an advisor good, in my opinion, reduce my taxable income, maximize my income, reduce my risk when the markets are down. That's it. To me, that is what matters. If you don't have a strategy that you can point to in your portfolio that you know is either protected against loss or can deliver double-digit returns if the markets are down to a point, then you're missing out. You are absolutely missing out in today's day and age. You're working with a dinosaur. You're working with an advisory firm that their model, their business plan is to raise as much money as they can, collect their fees. And then when the markets are negative, they're going to just tell you how it's time in the market, not timing the market, and all those things are true. But they're not doing it with their own money. I promise you that. And if you don't think the markets can stay down to flat or sideways for longer than, a year or two, just go back to Microsoft. You bought Microsoft in 2000. It took 14 years to get back to even. 14 years to get back to even. Now, the astute investor is going to say, well, he's cherry picking. It was, the .com. Yeah, you're darn right. I mean, who's to know what we're going to go with the market, right? I mean, what if we're at that level right now? What if the markets are high and we see, a subsequent, negative year 2 or 3? That, to me, truth be told, is what concerns me more than an '08, because '08s are generally, bought and then pop right back up. What concerns me is high inflation and low growth. Isn't that stagflation? That is what concerns me. Low growth and high inflation and subsequent down years in a row. So when an advisor says, the markets, you can't time the markets, well, that's garbage. Nobody's trying to time the markets on a day in and day out basis, but my goodness, that's what Wall Street does with their money every single day. They're not just setting it out there and forgetting about it. Are you kidding me? They would never, ever, with the firm money, just buy the S&P and buy a bond index and call it a day. Not a chance. Just listen to the earnings call. Listen to Goldman's earnings call, Morgan Stanley's earnings call, and listen to how much money is made from their trading. But yet, they're going to tell you, they're going to instruct their advisors to tell you that you just have to sit and take it. Well, again, no one's trying to predict the market. Nobody's trying to tell you that the markets don't go up long term always. That is not debatable. But the markets do go down, and the markets stay down for an extended period of time. And that can derail your plans. And more importantly, if there were no investments today that protected from downside or allowed positive performance in down markets, well, you know what? Then you just sit and take it. But that is not the case. It's the lack of advisors that want to educate clients, to talk about new strategies, talk about pros and cons. We're consultants. We are consultants, period, end of story. We're not selling anything except the ability to make the most amount of money possible with the least amount of risk. And to do that, in our opinion, you need to make sure that you're compounding your money. How do you compound your money? You limit your losses. How do you limit your losses? You have strategies that you can point to in your portfolio that are predetermined, predefined. We know what the rules of the road are going into them. That is when you're working with a good advisor. That is when you don't really care about the fee that you're paying to your advisor. And that's what we attempt to do on a day in and day out basis. So 630-492-1912, 630-492-1912. Give Paige or Jenny a call. Set up your initial meeting, Zoom, conference call, whatever you're comfortable with, and we can learn a little bit more about what you're doing and see if there's a good fit for us to work with you. I will get to the cash and money on the sidelines after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I am the founder of Kuhn Capital Partners. We are independent. We are a registered investment advisory firm. We are a fiduciary. We focus on strategies that can deliver positive returns in down markets. We focus on strategies that can greatly reduce your taxable income. Again, tax planning is year-round. It's not November, December. Unfortunately, a flood of money come in November and December to reduce your taxable income. But if you're working with a big brokerage firm or a big bank or even an independent advisor, if you don't have a strategy, if you have $1 million net worth or more, That means you're accredited, $1 million net worth or more, not including your primary residence. And there are some income accreditations as well. I think if you make, I don't know, a few $100,000 a year or something like that, just Google accredited investor. And so if you fit that criteria and you have not at least looked at a strategy that can reduce your taxable income by up to 90%, again, you sold a business, you sold a building, you have stock options, you have significant capital gains, you have are a high wage earner, you want to reduce those taxes. Now, we're not tax professionals. I have to tell you that. I can't give you tax advice. These are just for informational purposes only, albeit in energy, the tax strategies are very, very black and white. Best practice, always talk with a tax professional, of course. But if you want to reduce your taxable income, last year, had you invested in the energy fund, it was almost $90,000 per $100,000 invested. That is significant, very, very significant. Generally, it could be 50% in year one. It's up to 90%. Everything's going to be different. But generally, the investment over 2 years, you get to deduct 100% of it. Those are the things that we're talking about. Those are the things. If you want to do a Roth conversion, well, why pay that income tax? Why not look at this strategy? And if it makes sense for you, fits your goals, your objectives, your risk profile, why not invest in this? Well, guess what? We can mitigate those taxes in that conversion. Anyone can do a Roth conversion. You don't need me to do that, but you do need me to help you mitigate those taxes. Are those the things that your advisors are talking about? I could almost say I know for a fact, not a chance. But anyways, I digress, right? I go down these rabbit holes, and we've just been inundated with, I just ask people, plan for tax strategies January, February, March. Don't just wait till November or December, but we'll take it in November and December. But tax reduction, tax planning is a year-long activity. And I do not believe you will find anything close to the strategies in the energy space that provide those tax benefits. There's an old saying that the most profitable company is an oil and gas company. The second most profitable company is a poorly run oil and gas company. So the energy strategies, the tax codes are very, very favorable. Here in the Midwest, you are not getting brought these ideas. I just know that. You know, if you've listened to the show, that we spent 20 some odd years in Dallas, and we still have, our energy team is still in Dallas. We get to Dallas, Dallas, Houston, Fort Worth, et cetera, but Texas, let's just call it Texas. And so we have always been into alternatives. And when you can reduce taxable income and still give good targeted distributions, generally above market averages, well, again, it's about education. Let's talk about it. Let's talk about the pros. Let's talk about the cons. Let's talk about how we're mitigating the risk and how we set out to bring to individuals institutional quality strategies in the energy space. Predictability is always something that when we were crafting the fund that I stuck out in my mind, and that's what we want to do. So 630-492-1912, 630-492-1912. Okay, so I've talked about, do you let money sit in the market and wait for a correction, or do you put that money to work? Well, every advisor is going to tell you to put the money to work. Why? They want to get paid. They want to get paid. I was at a firm in my past life that if the money sat in cash for more than 3 months, guess what? We stopped getting our management fee on that money. How much of that money do you think would then sit in cash after that 3-month period? Well, of course not. Who's going to give themselves a pay cut? I think that is so, the conflicts of interest in that are just off the charts. Off the charts. If you're paying me, do you care if we sit in cash, if that's where we need to be? And then a decision of whether we reallocate that money back into the market just simply because the advisor's pay depends on it? I don't know if it's still that way. I probably would think it is. I just am no longer there, so I can't tell you. And it is a huge brokerage firm. So anyways, but there's a lot of people that have been sitting in cash waiting for a correction. And I get it. You're not alone. A lot of people have. Historically, stocks have had a 75% probability of closing lower at some point in the future. Those are pretty good odds, but it also means that 25% of the time, stocks just keep running, and you don't ever get the opportunity to get in at a lower price. So what my suggestion to you is you're looking at money management incorrectly. The point in time stuff is challenging. You can either be right or you can either be wrong. And I don't like those odds. I don't like flip of the coin odds. I would rather incorporate strategies in your portfolio that have a hedge, that have the ability, again, to protect against market losses. Again, the principal protection strategy. Tied to the S&P. Currently, it's 10 to 11%. Those strategies are out there, so you get the first, 100% of the return up to whatever the cap is. It might be 9, might be 10, might be 11. It just depends upon the strategy, and you don't get anything more. Well, okay, for your safe money, that might make a whole lot of sense because your worst down market scenario is 0. And when you get a gain's locked in, so you don't need to worry about playing that catch-up game. And then why not incorporate strategies like the banknotes, right? Double-digit returns in many instances with 30% downside. As long as the indexes that note is tracking are not down 30%, you're paid your coupon. Well, that gives you a lot of comfort to allocating to the market. So the reason why people, in my opinion, just sit on the sidelines and wait is because they don't have a good advisor. You're just, to try to do that, to try to make these macro calls of get in, get out, get in, get out. There's people that can do it, and there's people that are wild, just as successful as you can be. Here's the reality. They don't need your money. They don't need my money, right? So you can't time the market. You can 100% time the market. I can't time the market, but there are people that can do it. But they don't need your money, and they're doing it with their own money, so you're not going to get access to them. So what we have to do when we look at portfolio construction is making sure that we have to bring to the table strategies that have some sort of a hedge. A hedge is so basic. You hedge every area of your life. Insurance, think about it, life, health, car, auto, home, whatever, right? It's protecting against the unknown. But when it comes to the portfolio, your portfolio, the only hedge you have, because your Mr. or Mrs. advisor says, listen, don't worry about losing 20% when the market's down because you don't need this money. And this money over time is going to go up. Nobody's debating that. But I know, I'm not a math genius, but I know that if I lose less, I make more. Really simple, really, really simple philosophy. Let's just make it simple. I lose less, I make more. So rather than making these big macro in, macro out calls, put a hedge in your portfolio. And if you can't point to your portfolio that has a hedge, that this is the investment. This is the investment that can either protect my principal, or I'm not going to lose, or will still give me positive returns to a certain point, then you don't have a hedge in place. And in today's day and age, in today's world, that is a lazy, old school dinosaur advisor. That is not somebody, in my opinion, that you want to work with. We're not the only ones out there. Now, if you include the energy strategies, I am very confident in saying we're one of the only ones when you take a look at all that we bring to the table. But that being said, hopefully you got a lot out of the show. My job is to get you to think. That is it. Get you to think, get you to challenge your thoughts, get you to be able to challenge your advisor's thoughts. And if you are uncomfortable, if you're not certain of your situation, if you want to reduce your taxable income, if you want to have more predictability with certain investments, if you would like to have that portfolio stress test run on your current portfolio, we're here to do it. 630-492-1912, 630-492-1912. Give Paige or Jenny a call. They do get a lot of calls on the weekends, so if they don't answer, they're on a call with another listener trying to schedule their time to have their initial consultation with us. So give them a break and just give them a call back. But hopefully everybody has a fantastic week. I know Thanksgiving is coming up, and we're really excited about that. So 630-492-1912. Make it a great week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.